Hello everyone, my name is Chris. Welcome to this channel and thank you for joining me for this session on auditing stocks. Whether you're a seasoned manager, an accountant, or a small business owner, the gap between what your records say you have and what's actually on your shelves can be the difference between profit and loss. Today, in the next 30 minutes, we will demystify the stock audit process. We will transform it from a dreaded, chaotic event into a controlled, valuable business exercise. By the end, you will have a clear, step-by-step framework to conduct an audit that ensures accuracy, uncovers hidden issues, and ultimately protects your bottom line. Let's begin. So, why do we put ourselves through the effort of an audit? It's more than just a number on a balance sheet. First, financial accuracy. Your inventory is a key asset. If your records are wrong, your financial statements are wrong. This misleads investors, lenders, and most importantly, you. Second, loss prevention. Shrinkage from theft, damage, or simple misplacement eats directly into your profits. An audit finds these leaks. Third, informed decision-making. How can you know what to reorder, what to discount, or what's selling if you don't have accurate data? Reliable stock levels are the foundation of smart purchasing and sales strategies. And finally, customer satisfaction. Nothing loses a customer faster than selling an item you don't actually have. Accuracy builds trust. Now, there are two primary ways to conduct a stock audit. The first is the periodic or full physical count. This is the classic all-hands-on-deck approach. You shut down operations and count every single item, usually at the end of a quarter or year. It gives you a highly accurate snapshot, but it's incredibly disruptive. The second, more modern approach is cycle counting. This is a continuous process where you count a small, specific subset of your inventory every day or week. High-value or fast-moving items are counted more frequently. This is a best practice for modern businesses because it keeps your records accurate year-round with minimal disruption. For today's presentation, we'll focus on the framework for a full physical count, as the principles apply to both. To make this manageable, we break it down into 4 distinct phases. Think of this as the audit life cycle. 1. Pre-audit preparation. This is where you build your blueprint. 2. The counting process. This is the on-the-ground execution. 3. Reconciliation and analysis. The detective work begins. And 4. Reporting and follow-up, where you turn your findings into future profit. The success of your audit is determined before the first item is counted. So, let's dive deep into Phase 1. Phase 1 is, without exaggeration, 80% of the entire audit. Fail here, and your entire count will be compromised. First, plan and schedule. Choose a date with minimal activity, a weekend, a holiday, or after hours. Communicate this date well in advance. Next, assemble and train your team. Don't just grab whoever is free. Select staff who are familiar with the products but are not directly responsible for the area they are counting. This objectivity is crucial. Train them on the process, the counting sheets, and what to do if they find damaged goods. Now, the most critical rule, the inventory freeze. You must halt all receiving, shipping, and production movements during the count. Lock the doors. This is non-negotiable. If stock is moving while you're counting, the task becomes impossible. Then organize and clean. You cannot count a mess. Tidy the storage areas. Ensure every bin, shelf, and pallet is clearly labeled. Items should not be on the floor unless it's a designated labeled location. Finally, prepare your tools. Will you use pre-printed count sheets, mobile scanners, or tablets? Have clipboards, pens, and calculators ready. And just before the freeze, process all pending transactions and print a report of your system's expected stock levels. This is your book inventory. Let's visualize this. On the left, you see a clean, organized shelf. Every location has a unique identifier. This is the goal. On the right, you see a sample count sheet. Notice a critical detail. It is sorted by location, not by product type. Why? Because if you give a counter a list of all widget A locations, they will jump all over the warehouse and likely double count or miss items. By counting by location, moving methodically from aisle 1, shelf A, to aisle 1, shelf B, you ensure every spot is covered once. With the preparation complete, we move to phase 2, the counting process. This is where your plan meets reality. First, assign zones. Divide your warehouse into logical sections and assign a team to each. A best practice is to use a 2-person team. One counts, and a second independent person recounts the same area for verification. Remember the golden rule: count by location. Teams should move in a systematic pattern. Now implement the blind count technique. Do not show your counters what the system expects them to find. This prevents unconscious bias. They must record only what they physically see and touch. And yes, physically handle every item. Don't just look at a sealed box and assume it contains 10 units. Open it and check. I've seen boxes filled with packing material because someone made a mistake months ago. Finally, have a designated area for problem items. Damaged goods, obsolete stock, or items without a clear SKU. Tag them and note them on your sheet immediately. Once the counting is done, the real detective work begins in phase 3. Reconciliation and analysis. Step 1. Data entry. Input all the physical counts from your sheets or sync your mobile devices. This can be tedious, but accuracy is paramount. Step 2. Your inventory system will now generate a variance report. This is a list of every item where the physical count does not match the book inventory. It shows you the gaps. Step 3. And this is the most important step in this phase. Investigate discrepancies. Don't just accept the variance. For every significant difference, ask why. Was it theft or shrinkage? Was it a receiving error? Did someone record 100 units when only 90 arrived? Was it a shipping error? Did someone ship 12 instead of 10? Is it misplaced? Is it sitting in the wrong bin? Was it damaged and not written off? Or was it simply a counting error? Did someone mistake a box of 10 for a single item? Only when you understand the root cause should you move to step 4, adjusting your records. This usually requires a formal journal entry in your accounting system to write the value of the missing stock down to its true physical value. The audit isn't over when the numbers match. Phase 4. Reporting and follow-up is about closing the loop and ensuring the next audit is even better. First, calculate key metrics. Inventory. Accuracy. Number of accurate SKUs divided by total SKUs counted. Times 100. Aim for over 98%. Shrinkage rate. Book value minus physical count value, divided by total sales. This tells you the financial impact of your losses. Next, create a formal audit report. This shouldn't be long, but it should summarize what you did, what you found, the root causes of major variances, and the adjustments made. Most importantly, use this report to implement process improvements. This is the entire point. Found frequent receiving errors? Implement a double-check system at the loading dock. Found high shrinkage in a specific area? Improve security or lighting. Struggled with misplacement? Review your put-away procedures. This is how you turn a one-time audit into a cycle of continuous improvement. Before we conclude, let's lock in some best practices that will elevate your audit from good to great. First, if you're still relying solely on annual counts, seriously consider moving to cycle counting. Counting your A items, your high-value products, more frequently is the single best way to maintain accuracy. Second, leverage technology. Ditch the paper where you can. Barcode scanners and mobile devices connected to your inventory management system drastically reduce human error and speed up data entry. Third, segregate duties. The person who manages the inventory should not be the sole person counting it. This provides a crucial internal control. And finally, create a standard operating procedure, an SOP. Document every step we've discussed today. This ensures consistency, makes training easier, and turns the audit into a repeatable business process, not a panic-induced event. Let's be blunt. Here are the most common pitfalls that derail an audit. Rushing the preparation. I cannot stress this enough. A messy warehouse leads to a meaningless count. No inventory freeze. This is the #1 reason for a failed audit. Just don't do it. Counting by item, not location. This guarantees double counting and missed items, not investigating variances. If you don't find the why, you can't fix the problem. You're doomed to repeat it. No follow-up action. An audit without change is just a very expensive headcount. So, let's bring it all together. What are the key takeaways? 1. A stock audit is a manageable process, not a chaotic event. By breaking it into 4 phases, prepare, count, reconcile, report, you take control. 2. Success is determined before you start counting. The preparation phase is your foundation. 3. The ultimate goal is not just to find a number, but to understand the discrepancies and use that knowledge to improve your business operations. And 4. The future of inventory management is continuous. Embrace cycle counting and technology to keep your finger on the pulse of your stock at all times. You now have a clear, actionable framework to conduct a successful stock audit. You can move from the chaos of not knowing to the control of accurate, reliable information. Thank you for your time and attention. If you found this video is useful, please do share it with your friends, colleagues, and feel free to subscribe to this channel. Have a great day, and good luck with your next audit. Hello.